I'm getting nervous. All right, welcome everybody to the live stream here. A couple of my things aren't working, so I'm a little bit slow on what we got going on. But my name is Kyle. Here with me is Dan. Dan and I work together. We're both federally licensed loan officers, work in all 50 states. And so what we're going to do today is we're going to talk about, number one, everyone expected rates were going to drop. And we've been talking for what, Dan, weeks, months about how rates weren't going to drop because of the Fed decision. And so we're going to talk about that today. Why did rates, not only did they not drop, but they have actually kind of gone up a little bit. Right now, the 30-year conventional average rate is about 6.19%. And that's about what it was before. What was it? A little bit closer. It's probably like 6.1-ish, I think, last week.
If you click that, I think you can you go back in time? Yeah.
Yes, but the scroll bar is so tiny and so hard to see. What day was that?
Last Wednesday.
Somewhere
right
around there.
6.15 then, and
right about 6.1. Yep. So we're going to talk about that. Why did rates not drop? The Fed cut rates by 0.5%. And so why did mortgage rates not drop 0.5%? Actually have kind of climbed slightly up here. So we're going to talk about the day and then also answer your questions. So leave those here in the chat and we'll answer them. We already have a couple people here. We have AV8. Oh, that makes sense. AV8. Okay. Manny Man said, I'll be back. Control Alt Hero. Cool Guys is here. Tina, we have Lamont as well. We have Ronit, I believe, and Rakesh as well. Thanks for being here. We'll answer your questions. Dan, you want to talk about what's going on with the rates, economic data, what people can expect, and then maybe we can circle into why rates didn't drop.
Yeah. So let's just focus in on like this week. So this week was there wasn't all that much data coming in, but tomorrow and Friday, huge data. The Federal Reserve was created, and you might hear this phrase, the Federal Reserve was created for two mandates. It means they're supposed to control two different things. One is inflation, and two is full employment or the jobs market. The next 2 days, that's all we have. So tomorrow, I got, let's see, I have my calendar up here. Tomorrow, what we have is on Thursday, we have continued jobless claims. There they go. So on Thursday, can you do me a huge favor? Can you go back and add a double in the fact filters all the way at the bottom? There's a double. Yeah, right there. Thank you. So here's what we're seeing tomorrow. So remember, the Federal Reserve, their main focus now is jobs. They're like, we control the inflation piece. And that was, Federal Chairman Powell reiterated that. So tomorrow we're going to get a lot of that information. So continued jobless claims is coming out. And then GDP. GDP is going to play a huge role in this as well. And then the initial jobless claims we have there. And then the core PCE prices, that's not really the PCE figure that the Federal Reserve monitors. They follow Friday's report. So Friday is the PCE, the number one inflation report that the Federal Reserve puts the most weight in. That's coming in on Friday. So Thursday is GDP. Jobs report, and then on Friday is the PCE, the true PCE number, and we're going to see how that comes in basically on Friday. And these will be, unless they come in right in line, they will move the markets. Rates have gone up, and I've been saying, I feel bad for all those people that waited for September 18th before they wanted to start looking for a house or locking in. I said, guys, rates on the 18th, they're not going to go down 0.5%. It's basically supply and demand with a lot of this stuff. You can see right now the MBS market. For those that follow my channel, we watch the MBS market. This is the bond that trades on Wall Street that determines your mortgage rate. Okay, so the yield on this bond, you add this with what we call LLPAs. Those are loan level price adjustments, meaning, is your credit score high or low? That'll affect your credit, your rates and so forth. But right now you're seeing the mortgage bond down 23 ticks. What that means is when mortgage bond prices are down, yields go up. So this is probably going to push up rates, probably 0.1%, might not seem like much, but 0.1% on top of what we already have. So because the movement was later on in the day. So that's what we're seeing right now. One of the biggest reasons for why rates aren't coming down anymore is you could buy Treasury bonds almost with the same yield as you're buying mortgage bonds, and there's no default risk of a default in treasuries. On my screen, I have the right now the 1 month treasury, so it has zero chance of default, is yielding 4.6. Why would you go out and buy a mortgage bond getting a 5.5 yield and having the risk? So a lot of investors are just like, I'm not going to buy mortgage bonds. I'm not going to buy corporate bonds. I'm just happy right now with treasuries because the yields on those things are really nice. For example, a 3-month treasury is at 4.6 and a 6-month treasury is at 4.4. So you can basically stagger these things out and get a nice yield of between 4 and 5% on short-term maturities with treasury notes. That's what's going on. So that's why I keep saying the deficit is playing a huge role in this, because the way we finance our deficits is by offering treasuries, and the bond market is just saturated with bonds. So that's truly what's going on in the background right now.
Yeah. So here's an interesting comment. It said, I'm assuming this is to the title of the video of why did rates not drop with the Fed rate cut? So this person said, I'll tell you why. The entire system is a lie, manipulated beyond the control of the Fed. Big money and private equity have usurped America and call the shots. We're perpetually indebted to the corrupt system. Now, all that being said, the real reason why rates didn't drop is because the Federal Reserve, the Fed funds rate, doesn't control mortgage rates. It doesn't. What happens with the Fed is not what happens with mortgage rates. That's what happened. It's not because there's a corrupt system. It's not because they tweaked things in the back. The Fed funds rate just simply doesn't control mortgage rates. And so when the Fed funds rate goes up, mortgage rates don't go up. There may be other things that happen in the economy where the Federal Reserve changes the Fed funds rate, and mortgage rates also change based on the economic data, like jobs data and unemployment, things like that, but not because of the Federal Reserve changing the Fed funds rate. And also, the reason why we saw nothing happen is because the expectation of how the Federal Reserve is reacting to economic data is already been priced into the market. So we kind of been talking about this example over and over again, I think, on the channel, of like if we're looking at investing in stock. So if Tim Cook comes out, the CEO of Apple comes out tomorrow and says, hey, we're about to release our financial statements next month, and they don't look good. Well, Apple's stock today is going to tank. Not in a month when it's released. It's going to tank today because all markets are speculative. Mortgage markets, they're speculative. They're based on what we think is going to happen in the future. And so those rate cuts are already kind of baked in, not because the Fed controls mortgage rates, but because that's how the Federal Reserve is responding to economic data like inflation and jobs reports. And so the market's looking to the Fed to see how are they reacting to economic data in the US. And that data has already been priced in. It's been baked into what's happening with mortgage rates. Same thing with future cuts. And what we're expecting with inflation and jobs reports in the future is that's already been priced in. So rates are likely going to continue to trickle downwards over time as we see those reports come out, like Dan just mentioned earlier. But that's why we didn't see this drastic change, because the Federal Reserve doesn't control mortgage rates. And so when they change rates by 0.5%, it doesn't change mortgage rates by 0.5%. And in fact, we saw a perfect example is rates actually went up just a little bit. And so I know we keep like drilling this each time we do the live stream.
It's a great learning tool, because everybody's sitting on the sideline saying, you should see how many emails I received saying, Dan, I'm going to wait for the September 18th before I put a house under contract, or I'm going to wait till the December. They're supposed to cut a whole full percent, right? Or whatever. And so people want to wait, but as they're projecting these numbers out, the markets are correcting itself. Here's the one thing I am a little perplexed. They cut more than, let's say, half the market expected. Okay. Now the CME FedWatch tool is saying they're going to cut another 50 basis points. And that's where it's like, you would think the markets would be reacting a little bit better to this. And that's where that's the confusion part right here. But I'm still saying, there's so much uncertainty out there between the wars all over the world, our political situation right now that we have, our national debt that we're in, and just everything. And it's doom and gloom out there. But right through here. So currently, right now, the federal funds rate is what, 4.75 to 5. Is that accurate? 4.25 to 5.25 to 5.5. 4.75. I'm sorry, 4.75 to 5% is currently where the federal funds rate is. So the federal funds rate is what the Federal Reserve controls. Okay, it's basically interbank lending. You don't get these rates, and I don't get these rates. Okay, so right now on the screen, it's saying on the November 7th meeting, there's a 60% chance that the new Fed funds rate will be 4.25 to 4.5. So that means there's another 50 basis point cut, or a 0.5% cut in the federal funds rate. And I'm still perplexed why the markets aren't, I mean, they're telegraphing even better or bigger cuts. So why isn't the market? So I'm a little perplexed with this, and that's why I'm taking a deep dive in. But I think it's more political, and the yields in the treasuries, because everything especially analysts that I'm watching right now, a lot of people are predicting treasuries over equities for a duration of time right now, because they think the equity market is a little bit overbought at this time. So, only time is going to tell.
Here's a good question from Stephanie. They said, why do mortgage rates most closely follow the 10-year treasury yield if saturation of treasury notes is hurting MBS? Genuinely confused.
Why do mortgage rates most closely follow the 10-year treasury yield if saturation of treasury notes? Yes, sir. They don't follow the treasury as much as you think they are. Over history, what happens is the spread between MBSs and the 10-year treasury, usually about 175 basis points. Right now it's 250. And that's what's hurting the markets. I'm not understanding yields if saturation of treasury notes is hurting the MBS. Basically what it's saying is there's too many bonds in the market, and investors are choosing the ones with the highest yield with the least amount of risk, because they're risk off when they move into the bond market from the equity markets. So here's how history normally works with stocks and bonds. When stocks are overpriced, what happens is most people will say, okay, like 9/11. If you go back to 9/11, you'll see the stock market most likely just crashed, because people are pulling out of stocks and putting their money into what they call a safe haven. The safe havens are bonds. The true safe havens are government bonds. So people are buying into the government bonds because the yields are high and they have a lot to pick from. So there's all this debt instruments out there that you can pick from. You're going to pick the highest yield with the lowest amount of risk. That's basically what they're doing, and that's what's hurting the MBS market, because they're saying, okay, rates keep coming down. Rates on mortgages are starting to tick up to be more competitive now, so investors buy them. They need the spread back up there to make that make sense. I don't know if I'm rambling, if that makes sense. Okay.
And I think would it be fair to say that when you have investors looking at investing in the treasury market, for instance, they're going to be comparing the 10-year treasury versus MBSs. Those are going to be comparable investments for them to make. And so maybe this analogy reduces things a little bit too much, but it's almost like if Dan, you're selling red apples and I'm selling green apples, and all of a sudden you flood the market with a bunch of red apples. Well, red and green apples aren't too different, but the price of my green apples are probably going to start going down, right? Because there's just a ton of apples everywhere, and they're not so high in demand that people really care that much about the difference between the color of them. Yeah, I don't know if that analogy helps that much,
that makes sense.
Somewhat
there's just
similar.
Too much of it out there, so you're not going to pick the apple with spots on it. It might be rotten a little bit when you have all these apples to pick from, and you can pick that same perfect apple and get the same yield.
Yeah, they're both products that are fighting for the same money, basically.
Money, right.
So people are going to choose, the one that has the safer option, which is always going to be the treasuries over the mortgage-backed securities.
Hey, do we have any of our Mountaineer friends here today? We had, what was a Mountaineer something early. I wore my shirt just for the video today.
I don't know.
It's cold. It's cold up here too. Last week when I went to Florida, it was 95. Yesterday here was 60. So welcome to Chicago.
All right, Omek said, so is this an indication that a recession is inbound?
No, it doesn't really have, people say, well, an inverted yield curve, signals a recession. Well, we had an inverted yield curve for quite some time and no recession hit. Now you're starting to see that recession fears coming back up. So that's why today I have a recession video coming out, the closing bell. So we're going to go over the closing bell tonight. And then I'm going to go over what happens to the markets during recessions, and I'm going to go over the last 5 recessions. You'll probably be surprised at the results, believe it or not.
Cool. Let's jump into some questions here. Manny Man, all right, you said you'll be back. I haven't seen you yet. Lamont said, I understand the pros and cons of escrowing taxes and insurance payments, but how do both of you personally feel about escrowing versus not escrowing? So just a general recap for those who aren't familiar. So escrowing basically means that when you get a mortgage, what happens with most people is that the mortgage company is obviously going to charge you principal and interest. So principal is paying back the loan. Interest is the cost of having that loan. Sometimes you're also going to have mortgage insurance if you're getting like a conventional loan with less than 20% down. So the mortgage company is going to collect that. However, you also have property taxes and homeowners insurance that you have to pay even if you bought a house in cash, right? You still have taxes and there's homeowners insurance that you likely are going to want to have. Some people choose to not have it, I guess, but for most people, they will. Now, the issue with taxes and homeowners insurance is that insurance is usually paid in an annual lump sum, and property taxes most of the time are paid semi-annually, so twice a year, sometimes once a year. And so those lump sum payments for most people is pretty tough to budget for, right? If your property taxes, my property taxes are about $3,000 a year. So if I was not escrowing, then I would have a semi-annual bill due of $1,500 every 6 months. And so not everybody is budgeting for those types of things. So what mortgage companies do for most mortgages is they'll escrow them. Basically, they'll take a look at your tax bill and insurance bill, and they're going to collect that amount monthly and put it into a separate account, and then they'll pay your taxes and insurance on your behalf. So if your homeowner's insurance was $1,200 a year for easy math, they'll collect from you $100 per month. Then by the time your bill is due, they'll have the full $1,200 and they'll go pay that bill on your behalf. Now, the downside of an escrow account is that they have to collect a buffer. They have to collect a little bit more than that in that account, just in case things change or the amount increases, things like that. Otherwise, it's really difficult to manage an account that doesn't have a buffer. So all that being said, when it comes down to how do I personally feel about it, I think most people should have an escrow account. Most people do not have the budget or the financial flexibility to take on those lump sum payments, frankly. A lot of people think they're going to pay it, they'll forget about it, and then they're late on their property taxes. And that's not a position you want to be in. If you're really good at managing your budget, then absolutely, I think that's something you can do. But Dan and I were talking about this earlier. I think a lot of people feel like, that buffer money, it may be a few $100s that's sitting in that account that the lender is holding there for you. Sure, if you weren't escrowing, you might be able to manage that money, invest it somewhere. Your financial life is not going to change drastically by not having an escrow account. And I think sometimes a lot of people can feel like with these small decisions that they have huge impacts. You will not become a millionaire by not escrowing your taxes and insurance. It just simply is not going to change your life that much. However, it can be nice to have access to that money and you can manage it on your own, again, if you're comfortable with budgeting. But for most people, it's nice to have the convenience of knowing your property taxes and insurance are always going to be paid on time because someone else is taking care of that for you and you don't have to worry about it in your budget.
Perfect.
What are the factors that help in the appreciation of a home? That's a difficult question.
Well, here's what doesn't, and I'm kind of going to be sarcastic, but these are calls that I've had over the years. Like I've had somebody call me and say they bought a house and they put a new front door on and, painted the house and did some other things. Those could potentially. Here's what also doesn't. When you get into a house, putting on a new roof isn't really going to give the house value, but it sure is going to cost a lot of money. There's not, you can go in and do some rehabbing to the house and think, but I would suggest not having the nicest or best house on the block. That's called the white elephant. You don't want to have a white elephant. But so many people just think, if I did this, that, redo the whole kitchen, put $100,000 into your kitchen, are you going to get $100,000 out of it? Probably not. So it depends on your market. It depends on what's, you might be in an area where just they're going up no matter what, or they're going down no matter what. So be cautious of, what you actually do. Like when we bought our house, my wife talked us into, redoing our whole kitchen, and it was a lot of money. And because we were going to get the value out of it, when we sold the house. Well, it was 23 years ago and my kitchen's outdated again. So be careful on what you do. Don't spend a ton of money with a ton of upgrades and have the white elephant in the market. But a lot of times you just, unfortunately, there's nothing you can really control in most cases. Just don't let the house deteriorate, keep it up, maintained, and so forth. But the markets are going to mainly dictate the prices of the houses in your area.
Okay, Raina, thank you for being here. Is the next Fed Reserve meeting before or after the election? It's going to be
I think it's right before.
When is the election?
November.
What day is that? Is that November 5th? So the meeting is on the 7th, so it's going to be right after.
Oh, yeah, 2 days after. It was on the 7th. I forget.
That really shouldn't impact things at all. Not with a Fed meeting.
What's your take? Do you think the Fed is swayed by politicians?
Hold on. This is there we go. Oh my. Okay, I can do it all like this. To be honest with you, I have no clue. It's not something I really follow, so
got it. Okay. I just wonder.
I really don't have a good enough answer. I think
they don't. Yeah, I hope they don't, but you never know what's behind closed doors.
I think at minimum, I feel like it's not as directly political based on one administration over the other, but I definitely can see how the Fed is pressured in a million directions. And I don't know that there's a great way around it. I feel like there's probably a better way to put boundaries around the decisions that they make, or maybe make more like I'm trying to think of the right word or the right way to say it, like I don't know, more guidelines on the way that they make policy decisions. That way it could be more codified on, like, if this happens, we have these tools available, kind of more of like a policy that structures things that way. And maybe that exists already, but I just don't follow it enough, I think, to have a good answer on it.
I hope they don't, and I'll just leave it at that.
Rakesh said on MBS Live, which I'll pull up here, what does the UMBS 5.5 and 6.0 mean? That's a really good question.
They're actually different yield coupons. So they're different coupons. There's actually a 5. If you hit all the way at the top, click that. There's all kinds. There's 5, 5.5, 6. So we're using right now. They're different yield coupons and different buckets on where mortgages get placed and everything else. I'd highly suggest go to Mortgage News Daily, and I think they have a section in there that would explain those different coupons for you. But maybe I'll do a video on it. I don't know if there'll be that much.
I can explain it pretty well, I think, if you want me to take a stab at it. I was going to see where the it's probably under here, mortgage rates and MBS. Let's see. I'm sure there's something you would gain from reading. I'm not going to read this here while we're on this, but I'll pull this back up.
I talk with the guy that owns MBS Live, and Matt Graham, and we're trying to get him on the channel. He's actually having back surgery right now, and these are things where he can explain that. But he always, like, if I use a different coupon than 5.5, I get yelled at. So if you could, and he yells at me for that. So I appreciate that. So if you click that, it's just different variations of coupons.
And basically, like, the way this all works on the secondary market, I won't go like too in depth with it. This gives me flashbacks to economics, which I did terrible at because I didn't apply myself in college. Anyway, so basically, like, mortgage-backed securities, the way they work is you basically I'm going to oversimplify it. Take a bunch of people's mortgages, hundreds, thousands of people's mortgages, lump them all together in kind of one big pool of funds. And then you're going to divide those up into equal sized chunks called a mortgage-backed security. And so a mortgage-backed security, the way it's going to work is it's a bond. So it's going to be, let's say, $100 is usually the chunk that's given in. That's why we're close to around this range here. Now, that amount of money then has a yield. So this bond would then have a yield of 5.5. So effectively what ends up happening is you pay $100 to have the rights to that, and then you'll get a yield of 5.5% at the end of that year. So basically you made 5.5% on that money. And so if you wanted to invest $1,000, you're going to get 10 of these bonds that you're going to purchase. You then would have 10 bonds, all $100 each, that would pay 5.5% per year. Now, bonds, since they have a fixed yield, they're traded with this basically on the secondary market, and that's what changes this number here. I'm trying to think of a good example, maybe or a good analogy. I'm trying to pull everything into analogies, and maybe that's too difficult. But basically,
yeah, go ahead. You're doing great.
Yeah, that's why this number here changes, is that the more valuable this bond becomes, the higher the price is going to go, and vice versa. The less valuable this becomes, the more that number is going to go down. And so even though the original face value of this bond was $100, it trades differently on the secondary market, just like any other thing, like a stock would trade. Maybe it's helpful to think about it with stocks. Stocks, their price changes daily based on the demand for them. And then some stocks also have a dividend, and you could think about the bond's yield kind of being similar to a dividend of sorts. However, bonds just have a fixed yield versus a company may change their dividend over time. And so I don't know if that helps or adds more confusion to things, but basically what then ends up happening is when you get a mortgage, it's going to follow these types of coupons. And so basically on the back end, you don't get access to these rates necessarily, but that would be, your loan would be securitized into a pool with a bunch of other mortgages, and then traded similarly to these bonds here, just with a different price. And then from there, we'd have to go into like something that would probably take us another 30 minutes to explain. But that's too boring and not,
way too detailed,
and not fun.
You should email me sometime. I'll give you all the platforms I use to track all this stuff and everything. Happy to share with you.
Burner Anon said, purchasing in the next 7 to 8 months. Credit score is 750, 760, providing a down payment around 50,000, looking for a house range up to the 175 range. Income is 55 to 65 per year. How are my chances? That all looks really great. I think you have a strong down payment. You have a strong credit score. Income sounds good compared to the price of the home. Depending on where you're looking, that's the only thing I would maybe be concerned about, is 175 is going to be on the lower range of things. However, in your area, that may work. And I'm sure we're going to get the classic, someone's going to comment, that's a shoebox in San Francisco, as that always comes up. But that's the only thing I'd be mindful of, is maybe exploring those different markets to make sure 175 is going to get you what you're looking for. Robert said, new home prices keep falling. They're a leading indicator. The real estate market, existing home median price is a lagging indicator. Real estate correction is coming. All right,
here's Mike just posted a really nice video yesterday from Altos. And Robert, you might want to check out Altos Research. Check out their video that Mike put out yesterday. It's awesome. I'll leave it at that. And I did put it in my video from yesterday. Okay, I'm sorry.
Eccentric said market anticipates higher inflation in the future, even in the face of rate cuts. This can keep bond yields elevated. Interesting. Okay. Higher inflation erodes the real return on bonds, so yields must rise to compensate investors for this increased risk. Mr. McRae, you said something. I don't know what the Biden penalty is. If you can explain.
LLPA adjustments.
Oh, that's not a Biden
remember,
thing.
they put it in place. His administration actually changed the LLPAs.
Interesting.
So what they're talking about is, when Kyle and I, like when we were talking about the bond yields and interest rates and so forth, I say, well, your mortgage rates consist of the bond yield and then LLPAs and then the bank's profit margin. Do you have that can you pull up that LLPA thing? Because you have that like chart that shows you the red and the green and the yellow.
Yes. Oh, okay. Yeah, I guess I'm wrong. That was introduced by the Biden administration. Female PA charts. Yes, I can. Hold on.
So there are some sweet spots. Kyle actually made a really detailed video on it. So I'll let Kyle talk on this one because you know how they changed the buckets.
Yeah. So that happened in like 20, what, a year and a half ago, maybe somewhere around there.
Probably, yeah. Further, yeah.
So basically with the loan level price adjustments, I'll kind of explain briefly how this works and what you can do about it. So first of all, loan level price adjustments have always existed. They just have changed. In the past, whenever that happened, it was a year and a half or so ago. And so basically, this is for conventional loans. FHA government loans don't use LLPAs. But basically what you're seeing here, this is not the rate. This is going to be the cost of a loan. And I'm not going to go into it because I made a tool that makes this easier to understand. Basically, all you have to know is that you look at your credit score and your down payment, and it will show you the change basically in the price of the loan. So any of these numbers, you basically just kind of cut them in half. So a way easier way to talk about this is if you go to winthehouseyoulove.com/rate hack. What I did is I turned this chart into something that's way easier to understand. So what you can do is take a look at your down payment. So I turned it from LTV into down payment, so it's a lot easier. I'll zoom out just a touch here. And then your credit score. And then I turned this into, instead of loan level price adjustments, an estimated rate change. So here's what you would do is if you're looking at, let's say you had a 780 credit score, is I would come over here on the table. Now from here, I can see all the different down payment amounts that I could make and what that could do potentially to my interest rate. So if I'm comparing, let's say I was like, maybe I want to do 20% down. Okay, so 20% down is here. Now, if you did 15% down, you theoretically shouldn't get any change in rate. So getting 15% down, 20% down should be the same amount in interest rate. However, if you do 25% down, that should save you on average 0.188% on your interest rate. So if I can't do all that math in my head, but if you were getting a 7.188% interest rate with 25% down, you should be getting a 7% interest rate. So this becomes interesting then if you ever are looking at, let's say you were looking at doing 20% down or 15, yeah, let's do 15. Let's say you're looking at 15% down and you're like, I don't have any more money to do higher. Well, you actually could do 3% down and get a slightly lower rate, right? This number here is less than this one. You could get slightly lower, and by slightly lower, I mean, what is that? 0.188 minus 0.063. I mean, nothing crazy. We're not talking about huge numbers here, but technically you could do that to get a slightly lower rate and then put the rest of the 12% down on your first payment. So you locked in a lower rate with this. This really becomes better if you're looking at these big changes here, 1.4 to 0.875. And there used to be a little bit of this hack that you could do where you could do 19% down and get a better rate than doing 20% down. But that doesn't exist anymore, unfortunately. So that kind of disappeared. So this is the tool that you want to use to see, in here, especially too, I think a lot of people are kind of in this range of, let's say they're looking at 3% down and people are like, my credit score is 660 and I want to wait to purchase until I'm at a 700 or something. And you can actually take a look at, well, how much is this actually going to change your rate, right? Like these are not life-changing numbers necessarily. They definitely can save you money, but sometimes it can help you understand that, well, maybe it's better if we lock in the home and purchase it now rather than waiting a year or two for your credit to go all the way up to 780, because, it's, again, might only change your rate by, let's say, 0.5%. And again, that might take you 2 years to get to that spot to get your credit into the perfect position. So this can help you kind of make those decisions with some real life numbers.
This is also, can you bring that up 1 second? This is also an area where we focus in on and say, for example, if you look down, can you scroll over just to the credit score section? Like it's somebody with a 620 credit score and they're putting down 15%. Their rate is there's an adjustment to the rate of 1.4. So let's say the rate today is 6.25. You're looking at 7.75 or something like that. Or you go with an FHA loan and the rate's going to be, low sixes. these are the areas where, when there's those huge adjustments, those are the areas where it makes more sense in most cases to go with an FHA loan.
Yeah.
So those are things we help you along with.
We are currently, I need to change my little screen over here. Man, I wish my button over here worked. We're currently at a 6% thinking of refinancing. We recently called and were offered 5.375. Is it worth it to go forward or wait for a better rate?
Don't be wild over the rate. What do if you watch my channel, you should know this. You got to check what the fees are. Okay. So if it's free virtually, why not do it? If it's going to cost you $3,000, $4,000, $5,000, $6,000, how much is your savings? The Fed is cutting rates. Most likely rates are going to continue to drop a little bit. Are they going to go down to 3 or 4? No, but they're going to come down some. So the 5.375, make sure it's a fixed rate and your fees are very, very minimal. We also have a service where we can review these for you to let you know, is there a better offer out there? And that we have that. So Kyle, this might be a good time to pop up all the stuff, like to explain what this stuff is and so forth.
Sure. Yes. Take it away.
So if you want to, before you put in an application, what we usually ask people to do is we do this with you guys on the phone. And there's me, Alan, and David. That's the only ones in our whole call center that takes calls. Okay, so if you call in, you can schedule an appointment with us. You can just go to Kyle's website or you can go to my website and you can just schedule an appointment. You hit the apply now button on mine or on Kyle's, you can schedule an appointment there. You can ask questions. And then even on my website and Kyle's as well, if you go to the rateupdate.com, go to the top, there's a tag there that says loan estimate. You can click that and download your loan estimate in there. And usually within 24 hours, I'll review it and send you a video back letting you know if we can do better. This is also a perfect time for those to talk to a consultant here. Like I said, there's 3 of us. I've done this for 35 years. The rest of the guys have been doing it over 20 years. And this is what we do. We just basically consult you, let you know, here's what we would do. Here's the program we would choose. Here's how we do it. And then we're also a broker. So we work at, Kyle and I work at ServBank. ServBank is actually the 10th largest mortgage servicer in the whole country. We hold millions of loans. We're also one of the country's largest brokers. So we're set up with, I think there's 40 or 50 different lenders right now. So, most times when you're looking to get pre-approved or whatever, this isn't an infomercial. I want you guys to understand what we do is a lot of times if one company got you approved, like with a conventional loan or an FHA loan or something like that, most likely anybody can give you a loan. I'll pull the curtain back just 1 second and let you know how this works in the background. So what happens is, like, we'll do it, and the other lenders will do it. You fill out an application, we run your credit, and then what we do is we upload your data into 2 different systems. One is called Fannie Mae. One is called Freddie Mac. It doesn't matter if you know who they are, but as long as one of those companies approve the loan, the automated system, it's like, at Christmas time when you go to whatever company and you're shopping and they're like, hey, if you apply for this credit card, you get 10% off. Okay, you fill out some information, hit the button, wait 30 seconds, and boom, it's approved. That's kind of how this works. So if one lender got you approved, almost most cases, anybody can get you approved as long as they didn't do fraud. So now what are you looking for? You're looking for a low rate with good fees. So we can do all that with one application and one credit pull. And we're going to shop you with close to 50 different lenders. Now, is this going to be the end all beat all? There could be no better rate out there in the country? No. If you put due diligence in this and you worked on it every day for days, you'd probably find a better rate. Do you have that time to do that? Let us do the heavy lifting. You got enough on your plate at this point. So check out, go to the Rate Update or Win the House You Love. And if you want to put in an application or work to possibly get approved, check it out.
Sweet. Oh, this is perfect timing. Felix said, I highly recommend them. Excellent communication. And the site is easy to use. 10 out of 10. Thanks, Dan. Give them a thumbs up. Such a helpful group. Thanks, Felix. Amanda, hey, when refinancing, can you have an open insurance claim? Will that impact anything? Yes, you can. That shouldn't impact anything. Yeah, it shouldn't impact anything on the mortgage side for sure. Is there anything you can think of there?
Unless the house is burned down.
Yeah, that would be the only thing.
Then probably you're probably not going to refinance.
That's a good get.
Hey, thanks for coming, Amanda. You're here every week. We really appreciate it. Thank you.
I was assuming the house would still be standing.
Well, it depends on how screwed up the house is. What the insurance claim is. Is it major where lender's going to go in and say we ain't going to lend on that thing. So you have to, if you have a specific situation, reach out to us. I'd love to at least give you some advice on that.
Rakesh said, I think they are. There's no reason for a 0.5% cut based on the data we've got over the last 1 to 2 months. I don't know what we were talking about exactly there, but maybe the in political influence, maybe something around there.
And I was kind of on the same boat. Here's if you really watch every one of the Fed officials when they talk, and when Federal Chairman Powell came out, I can pretty much tell you what happened. When they saw that number from, I think it was Merrill Lynch, and there was another company that did like an audit of the employment numbers or unemployment numbers, there was like 800,000 jobs that were just like, where'd they go? And the Fed officials are pointing to data, but they're not pointing their finger to that specific number or that component. I think that spooked the shit out of them, to be honest with you. I think they came in and said, okay, the employment numbers are going, they're okay. They're getting kind of a little bit not good. But then when you all of a sudden have almost 1 million people fall off the payroll, and it was kind of like brushed under the rug for some reason. And if I wouldn't have found it that day, 2-3 days later, the data was virtually gone. So just odd. Put it that way. So I'm not a conspiracy theorist, but there's a lot of stuff going on right now that makes you scratch your head.
Let's see. In your opinion, are the November and December rate cuts already priced into the current rate?
Good question. I'm saying no at this point, but I don't know. There's so much in the background. If the market was just normal, and the Fed came out and cut 50 versus 25, the market would go nuts, just nuts. Then if they cut another 50, just look what happened many times when they just paused and people thought they were going to increase rates. They paused and the markets did well. So now they cut twice as much as most of the market expected, and the markets didn't really react much. And now the CME's telling us they're going to cut another 50 basis points, and the markets aren't really reacting as much as I thought they would be. So that's what I'm really working on in the background, because a lot of this information isn't making sense right now. So I'm diligently working in the background, trying to figure out all this mess. And a lot of things just aren't adding up. I'll put it that way. I'll get to the bottom of it, I promise. And we'll be back here to comment on it.
Lamont said, thanks for answering my question. I'm currently gearing up to purchase my first home. I'll be contacting you all early next year. Sweet. Thanks, man. Let's see. Stephanie said, my favorite live. You guys have done this so far. Oh, cool. Thanks, Stephanie. Learning so much. Sergio said, what happens if a contractor doesn't complete construction on a home by the closing date? What would you guys recommend? Oof.
Do they ever? I mean, every new construction we did, lately they've been pretty good. But in the past, I mean, you were talking months delayed. Currently, I think we have a couple new constructions going on, and most of them are on point at this point. I don't think there's much you can do at all, because you might want to check your contract. But like I said, in the past, like last year and the year before, when people were buying new construction, none of them closed on time. They were minimally 2-3 weeks late, if not further out. So there's probably no ramifications you can take against it. When you're signing that contract for the builder, trust me, it's pretty lock solid in their favor.
Let's see. Jep said, is there a possibility the interest rate can go back to 4% in the next 1 to 2 years? I'm on the side of, again, I don't know the future, but I'm on the side that anything below 5 is probably not going to happen for a long time. I mean, when we saw in the 2, 3, and 4 range was when the Fed was purchasing billions of dollars of mortgage-backed securities every month. And that was massively driving interest rates down. And they're doing the opposite right now, along with the other confusing economic situations we're in right now, all these unprecedented events. I just feel like we're not going to get there for a long time. Do you?
I don't. And I'll put it this way. It might sound weird. I hope we don't. Because the only reason why rates would get that low is because there's huge problems in the country or in the world. So you want, we want just stability in the world, stability in our economy, normal rates over history. And I know probably most of you guys hate that. Probably 6%. So Kyle, you probably never even seen a rate at 6 or 7% when you were a loan officer, starting out.
No, I mean, they were like, I think when I started, they were around 5-ish, 5.5, somewhere around there.
Yeah, they were 5 like forever, and then they went down to like 2.5 and stuck there. Yep. And now they're, just within 2 years ago, they rallied way up. So they'll come back down. Like I said, I'm still predicting a 5.5 handle, kind of right in that range within the next year. That's what I'm thinking. So if you're holding off for a 4% rate, you might be holding off for a long time.
5.5 seems to be this like healthy, this very stable point. Let's see, how different are soft and hard credit scores? Also the difference between FICO and Vantage. Here's, I thought of an analogy the other day that you might like. I've been really digging into these analogies. Okay.
You're probably chat GPTing them just to beat me, aren't you?
Yeah, just to get one up on you. I know this wasn't necessarily the question, but I was thinking like, a lot of times people ask like, okay, can you do a soft pull? And they're afraid of this hard pull. And why can't you just use a soft pull? It's hard to explain the difference between the two sometimes without getting super technical. And so a soft pull is like a movie trailer. Like you get an idea of the plot of the story, but you don't know how it ends until you actually watch it. So a hard pull is like watching the full movie. A soft pull is like watching the trailer. Again, you just get a picture, you get an idea, a sense, but you don't really know the full thing unless you actually watch it. And so a hard credit pull is required on a mortgage. And the difference can be pretty drastic in some situations. So Vantage usually is what you're going to get for a soft pull score. FICO does have soft pull scores. However, FICO is what's used. Every lender uses the same exact FICO scoring models. It is, I can tell you, it's FICO Score 2 is what Experian uses, FICO Score 5 is what Equifax uses, and FICO Score 4 is what TransUnion uses. And the Vantage scores can be sometimes higher or lower because they're different models. It really favors things differently. I'm not super familiar with the Vantage models, but I know sometimes they might have differences, like Vantage may favor newer credit versus FICO may look at a longer history, or one might favor installment debt over revolving debt like credit cards. And so there's not a good rule of thumb to say, there's Vantage is always 30 points lower, or it doesn't really work in that situation. Sometimes people have a higher soft pull score. Sometimes people have a lower soft pull score, and there's really no good way to kind of give a exact rule with those. So in my opinion, soft pull scores are mainly for tracking the momentum of your credit score, making sure that things you're doing are showing that it's continuing to go up. But really to get a mortgage pre-approval or pre-qualification, you're going to have to get a hard credit inquiry, and that's going to change your score 0 to 5 points. Like the world's not changing by getting a credit pull. So that's really the best way to look into your credit score. Do you like my analogy?
You are good, buddy. You're good.
Yeah, thanks. Been really working on that one. Oh my God, I'm just finding out there's like this huge fire downtown, and wow. Okay, that's awful. Let's see. Michael said, have you ever advised someone to not refinance, but rather to pay off the mortgage, especially if they only have a few years left before paying off the mortgage? I have before. I can't remember the exact details. It was somewhere along the line of someone, they had a lump sum of money and they had maybe a couple of years remaining on it. And they wanted to use like a refinance to help pay it down a little bit, like half of it. And I was like, just don't do a refinance, just pay it off. At that point, there wasn't like a crazy difference in rate too, but have you run into a situation like that?
Not specifically that. I mean, especially if you have like a year or two left, I don't know if I'd pay it off. You probably paid almost all your interest anyways. So but I probably tell people every day, no, it doesn't make any sense for you. Like I'll have people emailing me. I probably get 10 to 15 emails a day, people asking, is this a good time to refi? And then they'll provide me their information. I'll say it this way. It most likely you might want to refinance. There's multiple reasons why you look to refinance. One, you want a lower rate. In most cases, a lot of people right now that if you bought in the last year, you can do that. But what you have to do is be very conscious of the fees that you're going to pay. Okay. But I have a lot of people reaching out to me saying, Dan, I'm at like 6.75 and rates are at 6.25. Should I refinance? And I run the numbers and it's like, it doesn't make any sense. Or I'll run the numbers and in their location, title fees are $3 or $4 grand. I'm like, no, just hold off. So every day we make money by doing your loans, but we're not here to do your loans just to churn them and burn them. We're here actually to advise you and work with you to let you know the ideal time to do it. So yeah, I tell people all the time, maybe just wait, sit on the sidelines, wait for that number to come down a little lower and so forth. So yeah, good. But I usually don't, I've never told anybody just to take that extra money and pay it off. I'd tell them, put it in an investment and you'll probably gain more yield on that investment than you're paying on that mortgage. So just some ideas out there.
Let's see. Al said, I'm looking into renting out my townhouse and moving into a bigger house. Once I have my finances in order, what else should I be looking into? Do I need an LLC or a DBA? Really, I'm more on the opinion, especially, you have one house, you don't need an LLC. You wouldn't need a DBA unless you had an LLC. So an LLC really isn't going to offer you that much protection. I think a lot of people think like an LLC means that you can't touch me. You can't touch me. LLCs don't provide that much protection. They have to be structured incredibly well. And then also most loans that you're going to get are going to have, was like warm body recourse, meaning that even if it's in an LLC, you still sign your personal credit to it. And so they can still go after you no matter, you can't just like hide it. But I feel like I see so many people on like TikTok and YouTube and stuff who are like, here's the hack, start an LLC. And then they talk about how to get all these like credit cards and rack up this business debt. And it's like, well, you're in an LLC, so they can't do anything about it. Like, that's just not how that works.
Yeah. And you have to create the LLC, so it's going to cost you money. You have to file each year your LLC paperwork, which is going to cost you money. So unless you're doing it for, to really cover your butt, it's a lot of expenses that you don't need unless you start really investing in homes.
Yeah. Let's see what other questions we have in here. Let's see. Appreciate the advice. I'm in the Midwest, by the way. If you're in the Midwest, you're not allowed to use y'all. That's illegal. You can't do that.
Yeah. I can't.
No,
I can. You know why? I live in Chicago, but I'm from where, Kyle? I can say y'all.
What does that say? I can't see that.
West Virginia.
I said y'all once and, pretty casually, and someone I know who's from Texas got really mad at me. I was like, you need to chill out. It's not that serious.
Okay, so you're in Dayton. Where I grew up was right outside of Pittsburgh. Everybody said yuns. You ever hear the phrase yuns? Like, yuns want to go to the mall tonight? Or yuns going out to dinner tonight? That was y'all. So in the Pittsburgh area, if you're from Pennsylvania.
It's a second person plural pronoun used in Western Pennsylvania, particularly in Pittsburgh.
Bam! See, wow. I know what I'm talking about. Sorry. So if you're from Pittsburgh or the West Virginia or Pennsylvania area,
I guess it's
all doing
some
best.
Scottish Irish type thing. No one around here is saying that.
That's odd because you're close enough to where I grew up.
We're pretty far from Pennsylvania.
Yeah,
I mean it's a pretty long drive. Let's see, what kind of rate can I get? So we can't do like a rate quote live because there's a lot of info we need and a lot of disclosures and stuff. The best way, just shoot Dan an email. I'll put Dan's email in here. That you can send over, and that would be the best way to reach out.
Don't go anywhere just yet. Somebody on here, Renew Keeves. Oh, I didn't mean to speak, blow into my mic, but
I'll pull that one up next.
Okay.
Rakesh said a lot of people keep calling for a crash, but to have that, there needs to be a lot of supply in the market. Majority of people have 2 to 4% rates and equity in their homes, so even if people lost their jobs, they'd still be okay. Yeah, that's kind of the position that we're in. Is it's like 90% of people have what below wasn't it like a 5% or below or something like that? Like a crazy amount. A lot of people have low rates. And to be fair, even with low rates, if a lot of people lost their jobs, there's going to be a lot of people who still can't afford their mortgage. It's definitely not going to be as intense as the people who have 7, 8% rates, but there'll still be a lot of those people in that situation. But yeah, I mean, for a crash to happen, there would have to be supply would need to flood the market, or there would have to be a dramatic drop in demand, which that's much harder to see that happen.
If 8% rates didn't do it, which it crumbled the demand, and I get where a lot of people saying that the housing market's going to crash and things like that. What they didn't take into consideration is how many people refinanced and just stayed. So, and then also with transparency, YouTube, we make some money by doing things on YouTube. Go back to a lot of those crash video people. I'm just saying, just do one piece of research for me. One piece. Go back about 2 or 3 years ago to the videos that they started doing, and they were realtors and financial planners, and they were trying to educate you. Then all of a sudden, this crash thing started, and people were making tons of money by clicks and everything else. So then everybody moved their channel to the crash videos. So just do me one piece of information. Just check out that crash video person you're watching. Go about 2 years back. Let me know how many views they got back then when they were trying to help people buy homes. It's probably 300-400. Now they're into the crash module and they're getting 25, 100,000 views a day, and none of their videos make any sense. So perfect analogy, and we appreciate your comments there.
I do know one of the top housing crash people at one point, when the videos were really kicking off, was making around $60,000 a month, like $60,000 a month in revenue from YouTube. Just a heads up, we don't get it. We're not close. We're not pulling in those kinds of numbers here.
That's why they do it. I'm just telling you, folks. And then they get these high-profile people. You can go to Wall Street. Every market has their naysayers. You can go to any market, and there's the crash and doom. Everything's going to be bad. But please do me a favor. Just analyze their data that they gave you this year, last year, and the year before, and just provide the accuracy that they provided you. That's all I got to ask you to do. So check out how they did prior to crash videos, and then what information are they providing you other than it's crashing. Okay, what did you learn? You learned nothing. Okay. Our channel is to help you learn. Even if you don't buy now, you buy 10 years from now. Hopefully you can learn some educational and economic advice from our channels.
And I don't know what to call it, but maybe it'd be interesting for us to talk about this at some point. There's this level of like with the crash stuff, for instance, I think it's easy to hear that and then not even ask the question of like, what does a crash mean? Define crash. Like, what does that actually, we hear crash and then we take everything, all of our emotions start to swell up and inform us about what that means. So someone might hear crash and that means, well, I can't afford a house now, but something's going to happen in the future. And all of a sudden that home's going to drop half in price. Now, is that true? Is that what that person means? Or another good example is like, the escrow. I think often a lot of people will debate these things like escrow. Should I get escrow or not escrow? And they make these huge decisions about should I do this or not? And if you actually break out the numbers, okay, if you invested that $1,000 that you could save by not escrowing into the S&P 500, sure, you could make some money, but it's not going to be life-changing money. And I think what's happening is in real estate is there's a lot of these small decisions, and people are feeling so overwhelmed by everything that they need to do, every decision they need to make, all these tiny little things that can happen. And it feels like these small little things have so much consequence on your life. And so that's just not... hopefully through watching us that you're beginning to understand that these small things, they have impact, but they're not going to radically change things, right? So I don't really know where I'm going from there, but yeah. Did you have something that? Okay.
No, you're on. I mean, we're just trying to open the doors so you guys can see behind it. And if you really saw what was behind it, you'd be like, oh, I get it now. So just letting you know.
Rakesh said, is title insurance a scam, especially if you're buying a new construction home? No, you should absolutely get title insurance. And I know a lot of people feel that way with new construction. And so title insurance, the goal of it is a couple of things. So first, when you buy a home, no matter if it's already been owned by someone else before or it's new construction, a title company is going to research everything and make sure that when you buy that home at that time, that you're going to be the sole one who owns that home. Because real estate can be really complex, and there are a lot of digital records, but there's also a lot of paper records that are stored by a county recorder. And so it's really happens so often that there might just be a lien that's added to a property, and maybe it wasn't found until 3 months later. And then all of a sudden a contractor comes and says, I want to collect this lien. Or someone, maybe there was an estate that got handled, that was mishandled by an executor or a court, and maybe someone actually technically owns a partial claim to a property. There's so many instances where even around here there's a development that it was basically one of those types of developments where they were buying people's homes for like $1 million. And these were like $100,000 homes, but they wanted that plot of land because the commercial real estate was so valuable. And so that caused a lot of friction because all of a sudden you had, one of those situations where a parent died and they gave the house to one kid, and then the other kid said, I don't really want the house anymore. And now that it's worth $1 million, the other kid comes along and says, oh, actually, I own that part of the house. And then they go to a court, and now a court has to figure out who owns the home, right? How are we tracking records of who owns this house? And so things like that, title insurance is able to come in and actually either help you litigate that or pay to settle it. That's the main benefit of title insurance, is to help you make the problem go away. That's mostly what title insurance is doing, is they're mainly saying, you know what? We're making the problem go away. This is not worth the years and years of work. We're going to just pay off this person. And that's often what happens. There was another instance somewhere in the news, and someone brought up a comment about title insurance, and they were like, title insurance is stupid because of this situation. And basically what it was is someone owned a home. There was a false document filed that they were in foreclosure. Some other person came in and fraudulently signed the title of the home over to themselves, which again, complete fraud, completely illegal act. However, with the way that property records work, they're just slow and difficult to maneuver. That person now has technically title to this home. Okay, now you have this man who's saying, I can't believe I have to pay my own attorney fees to make this situation go away. Well, if he had title insurance, he wouldn't. He would file a claim with his title insurance, and the title insurance would take care of it. They would hire the attorneys needed to make that work. They would pay everything off. But he didn't pay for title insurance, so he's the one paying for his own attorneys, even though there was fraud involved. So title insurance really is valuable. It's one of those things that you probably are never going to use it, frankly. But it's cheap enough that it's really worth it to have, considering the costs of not having it. So, yeah. Aaron said, learning tons from you, Dan. Thanks so much for doing this.
Hey.
And then Aaron also had a question saying, can you talk about how a VA EARL differs, please? Looking to refinance it soon, hoping to see a 4.7 to really make it worth it.
I just submitted 2 of them just the other day. Each were 1.1 million and 1.2 million. Both of them, I was able to get rates with no points and no lender fees under 5. And they're EARLs. EARLs are crazy simple. It's basically paperwork. We don't need your financials. We don't need an appraisal. We really don't need much of anything. We just will pull a soft credit pool. It's going to be a mortgage only, just to make sure you've paid your mortgage on time and everything else. And then it's just paperwork. So Aaron, if you'd like our assistance with that, I'd love to help you with that, because we do a lot of VA loans.
Sweet. Cool. Well, yeah, as Dan mentioned earlier, we work in all 50 states. And if you're interested, if you just have a question, similar to how you ask questions on here that you want to talk with us about, or if you want to get pre-qualified, you can schedule a call at winthehouseyoulove.com and set a time on our calendar that works for you, so we don't have to play phone tag back and forth. And so you'll either be connected with Dan down below, Alan, or David on our team. All have over 20 years of experience. And so we'd be happy to help you with your questions, figure out what loan is right for you. We also have several grants. And so on the call, what we'll do is we'll scan the grants that we have to see if you can qualify for any of those. So if there's free federal money available for you, we want you to be able to take advantage of it. So thank you all for being here. Donald, I'm so sorry you just joined, but we do these same time, same place, 3:30 Eastern. Every Wednesday. So we'll be doing this next week as well. There's plenty of ways that you all can get in contact with us. So again, you can go to winthehouseyoulove.com. Here, I'll just pull it up for you really quickly. There we go. So you can click, you can click get pre-qualified here to schedule a call. If you just have a question, you can click I just have a question first, and we can answer that. And then you can also email Dan or I at any time. So we'll see you all next week. And thank you all for being here.